Good evening. Welcome to Markets Today. I'm Lata Venkatesh with me is Surabhi Upadhyay. We started off trade expecting that the markets may give away a lot of Friday's gains because we saw a lot of losses on the Dow Jones index and mixed markets in Asia as well. But the Indian markets actually started gap down and saw a lot of the dips getting bought. In the end, the market could not make gains, but at least it ended in flat terrain. The question hereafter is, will the rallies be sold into? Yes, the dips have been bought, but how courageous are the bulls to take the markets forward? And how much will the F&O expiry on Thursday confuse the leads in the market? All those will be discussed later on today. The bank Nifty led from the front. That as well will be discussed. Hi, Surabhi.
Hi, Lata. So not a bad way to start the week after all, considering at least we didn't fall as much. Let's quickly get you the headlines. A day of consolidation on Dalal Street. The market bounces off the day's lows to close just below the flat line. The Nifty ends around the 79.80 mark. The Sensex loses 30 points. Banks and power stocks see buying, but FMCG and Oil and Gas shares are under pressure.
Midcaps outperform blue chips with the index ending 0.4% higher. Power stocks like CESC, Reliance Power and Torrent Power gained 5 to 7% on reform hopes. Amtech Auto, Archies and IVRCL surge on strong volumes. Motherson Sumi tanks 8% as its biggest client, Volkswagen, is forced to halt diesel car sales in the US following a row over emission norms.
The CNBC TV 18 Impact IDBI Bank shares rally 17% after Finance Minister Arun Jaitley tells us that the government could look at recasting its shareholding in the bank on the lines of Axis Bank to offer more operational autonomy to IDBI Bank.
Well, those were some of the headlines that dominated the market's mind space. Here are the experts we have lined up on the show for you. Big market voices from Singapore and Hong Kong at the Finance Minister's investor meet. Akash Prakash of Amansa Capital, Rahul Chadda of Myre Asset Global Investments and Sunil Singhania of Reliance Mutual Fund speak to us about what makes India still attractive compared to its emerging market peers and whether the global sell-off in emerging markets will impact us. We will also listen to Nilesh Shah of Kotak Mahindra Mutual Fund on which sectors he would bet on.
All right, so lots of opinion coming your way, but first up, the day's trading action. Market staged a solid recovery after a big gap down open to end almost flat in trade. We've got Anuj joining in with the day's trading highlights. Anuj, what's your sense? Not a bad way considering how we opened. What sparked this big move up?
Well, two or three reasons that the market saw the kind of recovery that it did. First was that it, of course, was the expiry week. So, there were pulls and pressures of expiry week. And the second most important was that bank stocks saw quite a bit of buying, and that led to that sharp recovery. In fact, the Bank Nifty closed about 350-400 points off the morning lows, well into the green, even if the Nifty ended marginally in the reds. Midcaps also outperformed today, so it was overall a good day. In fact, if you bought the gap down, you would have made a lot of money in today's trade. Let's talk about the stocks that led the market lower today, because at the end of the day, it was still a down day. So some of the stocks that kept pressure on the market today included Reliance, that was down 2%, ITC was down 1%, and Bharti Airtel was down about 1%. Apart from that, some other prominent Nifty losers today included the FI favorite ones, names like Asian Paints, Bosch, Dr. Reddy's, all of them down about 1% in today's trade. On the gaining side, it was about banks. Both private sector banks and PSU banks were doing well today. Axis Bank was up 2%, for example. State Bank up 1%. Kotak up about 1%. And keep in mind, most of them actually opened in the red. So from that point, there was quite a bit of recovery that you saw in some of these banking names. Apart from that, the stocks that helped the market today, Maruti back to 4,500 in a jiffy from the recent close of 4,100. Power Grid was up 2%, and Larsen & Toubro was up nearly 1% in today's trade. Onto the mid-caps then, there was quite a bit of outperformance. Stock of the day, of course, was IDBI Bank. That really was the CNBC TV 18 analysis impact. That stock was up 16.5%. JP Associates up 13%, and Shipping Corp was up 10%. Not just that, some of the gainers in trade today, including names like Granules, Dish TV, and even Amtech Auto. And the notable loser today was Motherson Sumi. That stock was down about 8% in trade. So overall, a good day for the market. The next 3 or 4 days, of course, expect for some more intraday volatility in a small band because it's expiry week, and maybe we'll have a trend for the market in the next week when we have the RBI policy as well.
Oh, yes, of course. Thanks a lot for that, Anuj. Well, I must say that in the end, the market seemed to be showing more resilience. The market had a runaway rally on Friday after the Fed pause, and at that time most of the Asian markets were either flat or middling, and the US markets themselves had reacted very poorly on Thursday evening to the Fed pause. Thereafter on Friday we saw that massive sell-off. One would have expected under the circumstances probably a little bit of creaming, but it was a very shallow profit taking that we saw, which got bought into. So I would think that the Indian market once again proved its outperformance. But again, so far so good. It remains to be seen whether the markets are able to build on this. Yes, the bottom of this market is certainly protected, either because there is an India story out there which is so much better than other competing stories, and or because there is domestic money also that is fueling this rally. That puts a floor which is reasonably high, but does it give enough legs to move the markets much higher? That perhaps will be confused this week itself because of FNOQs. We will have to wait for Monday and the post-rate cut, post-credit policy movement to check whether this market has really what it takes.
Well, so a couple of anxious days ahead, but on that note, let's get some opinion going as well. What's the longer-term view on India? Speaking to CNBC TV 18's Shireen Bhan in Singapore, Akash Prakash of Amansa Capital says that the emerging market basket as a whole, as an asset class, is under serious stress at the moment, and India will be held hostage to emerging market flows as a whole.
India has a consensus overweight. You look at any survey of fund managers, India has never been a higher relative or absolute weight than it is today. So in a situation now, if EM continues getting outflows, which is what's been happening for the last 2 months, it's very difficult now for fund managers to not sell India if they keep getting outflows. You can't keep raising the weighting beyond a point, right? There's risk control measures, there's absolute risk you're taking. So if EM gets outflows, India will get sold because people don't have a choice. And that's what you've seen in the last 1 month. I think the domestic flows have been strong, so we've compensated. But I think India now is going to be held hostage to EM flows as a whole. The downside is not very dramatic. So I would say maybe 7,500 on the Nifty, maybe 7,200. I don't think it goes much below that because there is strong domestic buying power, which is continuously coming. EM as an asset class is under serious stress at the moment for various reasons, strong dollar, weak commodities, China. I don't think that goes away immediately. I think the concerns around EM are going to remain there. I think the Fed is in that sense important, but not the critical reason why EM is in stress. It's not the only reason. So I think it remains a sideshow. China has taken over that role of creating volatility, right? I mean, of course, you had Europe and Greece, which now seems to have gone away. Then you've got China, right? And China, I think, is, now over the last 7 or 8 years has created more economic growth than the US and Europe combined. Right. And there is great uncertainty around China in the sense because of the unreliability of the data and the fact that they're changing the growth model. No one is 100% sure what exactly is going on. So I think that is the bigger source of volatility.
All right, that's our view on the markets. Now let's talk about some specific stock action. IDBI Bank surged nearly 17% in trade today on the back of the finance minister promising some more autonomy. In fact, finance minister was speaking to us in that exclusive interview, saying that the government will maintain an arm's length distance, just like Axis Bank, to infuse some more professionalism and freedom in decision making. Let's hear him out.
There's a little flexibility we have with regard to banks which are not under the Banking Companies Regulation Act, for which no amendment is required, which are only registered with the Companies Act. The Axis Bank, for instance, and that's the model, where through various government instrumentalities, there's a major shareholding that the government has, but the government maintains an arm's length distance, and it's a bank which has done remarkably well. And therefore, can we, with regard to any other institution that we have, the IDBI, follow that model?
Okay.
And therefore, its levels of professionalism, its level of quality, its freedom of decision making, its autonomy, etc., can be maintained.
All right. So the government right now directly owns 75% in IDBI Bank. In Axis Bank, it holds its stake through various government-owned entities like LIC, for instance, or SUTI. Lata, what will this mean? I mean, the hint enough was enough to power such a mega rally on IDBI Bank. What will this imply?
Well, the motherhood statement is when a bank is owned by the government, when it is a child of the government, a subsidiary of the government, it is under all controls of the government itself. It's like the CBC, the CAG, and the recruitment has to be on certain national recruitment parameters. But if it is a grandchild of the government, that is like Axis Bank, the government owns its stake through LIC, as you said, or through other entities, then it is not amenable, or it is not under the surveillance of a lot of government agencies. It behaves like a private sector unit. We always consider Axis Bank a private unit. It's not just Axis Bank. Look at SBI Mutual Fund. SBI itself is regulated in terms of its ability to go and recruit from colleges. It can't do that. There has to be a national recruitment exam. But SBI Mutual Fund can recruit anyone, pay them any scales, hire and fire any way they like. It behaves like a private sector unit. Why? Because SBI MF is a grandchild of the government. It is not owned directly by the government. It is owned by a government-owned entity, namely SBI. So that is what the finance minister seems to be hinting. He can't do much about, the Bank of India's and the Bank of Baroda's and the Dena banks, because they're all owned under the Banking Regulation Act directly by the government. But it can do something about the IDBI bank, because it is held under IDBI Act.
All right, so that was IDBI. Big move on the stock today. And before we move on, actually some more news on the banking space. Lata, we also saw a lot of other PSU banks rally in trade today. And I guess some of it coming from that interview that we got over the weekend, where the finance minister is now consistently promising some kind of a solution to the DISCOM problem. What will this mean for banking?
It's very positive for banks. The conversation that we heard from the finance minister, what the finance minister basically said was that DISCOMs, the power distribution companies, cannot run themselves in such a way that their losses can be perennially funded by public sector banks. That won't do. And so the central government is talking to various state governments, and probably some arrangement will emerge whereby, with some help from the central government, the state government will take over the loans of DISCOMs. He was short on detail, but he was very clear about the intention that the government has to ensure that public sector banks are saved from perennially holding the bad loans or the extra expenses of the distribution companies. This is a twofold gain for the public sector banks. One, they are at least sure that the DISCOM loan will not turn into NPLs. Also, if somehow the power distribution companies are hydrated with their loans being pulled out and made state government loans, their interest cost falls. They get a little cash in the hand, they can start buying power. At the moment, a lot of power generating companies are in danger of becoming sick or danger of not being able to meet their interest commitments because nobody is buying their power. So even the power loans of the public sector banks become a little safer if the DISCOMs are financially revamped in some fashion. Which is why today we saw a 1.5% rally in the PSU bank index at a time when the Sensex and the Nifty were flat. And the bank Nifty itself rose only 0.7. Bank Nifty is a private bank index. The public sector bank index has risen 1.7%. There you are. It just goes to prove that, people, investors and traders are kind of hitching on to this hope of DISCOM revamp.
Oh, absolutely, some very far-reaching consequences as and when that proposal rolls out. What the finance minister has told us that offers should be made at least to 8 states in the near future. But now let's move on to some other stock-specific action. Motherson Sumi continued its downward journey today. The share lost more than 8%. Sonia Shnoy is joining in to tell us what's happening here. Sonia?
There are 2 reasons for which Motherson Sumi was under pressure today. One is that its biggest client, Volkswagen, admitted to fudging the emission norms for diesel cars in the US. And now Volkswagen has stopped selling diesel cars in the US with immediate effect and could face a big fine as well. Now, of Motherson Sumi's entire revenue pie, 40% of its earnings comes from the Volkswagen Group, and this news flow is a big negative for them. Apart from that, channel checks are indicating indicating that Motherson's domestic business is also slowing down. In fact, Maruti, which is one of Motherson's biggest clients, is decreasing its single vendor concentration. Now, just to give you the numbers, currently Motherson Sumi has 85% share in Maruti's component parts. So 85% of Maruti's component parts are supplied by Motherson, but now Maruti wants to decrease its single vendor concentration and enforce one single vendor not having more than 70% share. So that means Motherson Sumi's revenues will suffer, and other Japanese wiring harness majors like Yazaki and Furukawa are starting to gain share. So it was a double whammy for Motherson Sumi today, because of which the stock fell 8%.
You said it, Sonia. Not like Mother makes for Motherson Sumi today. All right. Market veterans are warning of short-term pain in Indian equities, even as they remain confident of the longer-term India story. That's the other theme we got from various large investors at the Investor Summit that the Finance Minister has been holding in Singapore and Hong Kong. Let's listen to Rahul Chadda of Myre Asset Global Investments and Sunil Singhania of Reliance Mutual Fund.
Clearly, India stands out. I mean, if you look at our funds, India is a big overweight for us, and we believe that India is the best equity stories. But like we've said before, in a period of dollar strength where all EM economies are just becoming a basket case, I think the onus is up to Indian leadership to do the necessary reform. See, we can't say just because we are India, money's going to come to us. Yeah. Because people watch, I mean, like in Hawk, on what are the steps we are doing.
There are three buckets of flows. One is obviously the emerging market flows, the other is the global market flows, and the third is the country-specific flows. Country-specific flows were prevalent till 2007. And then, country-specific became sort of not in fashion, and flows started to move either in the developed market funds or the emerging market funds. I think what we are seeing as an AMC is flows coming back into country-specific funds. So you're right that emerging market India might be overweight, and we don't see any reason why this overweight will not continue. But there are this global funds who are started investing in India. There are country-specific funds, country-specific flows which are coming to India. So our optimism on flows continues to be as strong as ever, and we believe that every year India will get higher flows than the previous year.
Some big news coming your way from Singapore and Hong Kong. Time for a break now, but when we come back on the other side, Sudarshan Sukhani is going to be joining in for a technical chat. And as always, we'll get you some stock ideas for tomorrow.